Hi, Joe Lopresti here with our latest Arlington Wealth Management Proactive Strategy Update for Friday, September 8th. Since our last update, the pullback in the market has continued. We're in about 5 or 6 weeks into this correction. At this point, it looks to us as though it's more technical and seasonal in nature and probably not the beginning of a significant market pullback or bear market. In fact, we speculated back in July that if we were to get a correction in the second half of this year, it's probably going to come in the August-September timeframe, and sure enough, that's what we're dealing with right now. In this update, we're going to review our core indicators for our market model to see what impact this correction has had on each of those indicators. We'll then take a look at the tactical indicators to see if we could get a handle on how much of the correction is in the rear view mirror versus how much more could still potentially be ahead of us. And then we're going to update you on our recession warning models with all the data in for July, because if there's anything that could cause this market pullback to develop into something more meaningful on the downside, it would be the recession window closing. So let's dive into our proactive asset allocation dashboard, and we could see all the arrows still pointing up here at the top. So that buy signal going back to last November is a little more than 7 months in length. We can see the core indicators still are all pointing positive. So far we're not seeing any material effects in these indicators that this correction has caused. What I'd like to do is take a look at each of these indicators and give you an update on how they're developing, and then we'll take a look at the tactical indicators. So let's start off with looking at our universe trend indicators. What these charts record is the percent of a very large global universe of stocks that have positive trends individually on their individual stock charts. We look at 2 different stock charts for each stock. One uses a traditional scale, one uses a logarithmic scale. And what we could see is the last entries here were in July for each of these charts. The more sensitive of the 2 is the traditional chart. It hit a high of 54%. It's now down a little bit below 50. So we've seen about 4 or 5% of the universe flip from positive trends to negative trends. If we were to get another 2%, that would cause an O column on this chart. So the threshold is 6%. We need to see a 6% drop from the 54% reading down to the 48% reading. We're not there, although that could happen. It's approaching that level. What we see here is the pullback that occurred in March was a higher low, and now in July we hit a higher high. So this is a positive pattern for the universe trend indicator. If we look at the logarithmic version, it too peaked in July at 60%. It's off just a little bit at 59%. So far we're not seeing material drop in breadth during this correction. That could still develop. If it does, we'll see it in the traditional scale chart first. But really, unless both of these shift to negative, would that cause a significant concern? If there was a negative to point out, it's this. The July high is materially lower than what we saw in 2021 at its high. So in May of 2021 is when this indicator hit its high at 78%. We had the sizable drop, which started at the end of 2021 and picked up steam in 22, bottomed in October. This is the rebound so far during this bull market starting last fall. The markets came close to a high, but this indicator, at least so far, is still almost 20% below its high. If we look at a chart of the MSCI All Country World Index itself, we could see the late 2021 high, the big drop in 2022. It was a 27% drop from high to low. The recovery at the end of last year and so far into this year, you see the market did come close to testing its high. It didn't hit a new high, but it was within 7% of hitting a new high before backing off here in August and September. Seeing this chart significantly off of its high, is a bit of a long-term concern. We want to continue to monitor that into the future. Right now, things look good. We're seeing, generally speaking, until this correction hit, some improvement in this indicator, some upward moving patterns, but both are significantly off of their 2021 highs. This correction that's occurring now, more than likely we have a little bit more to go before it's over, but once it's over, it could set up a year-end rally once we get out of this September period, starting in October, November, December, generally a better seasonal period. Wouldn't surprise me to see indices test the high or even hit new highs. When that happens, we want to monitor to see how these universe trend indicators perform during that time. Ideally, they too are hitting new highs, indicating that more stocks are participating in the high in the market. So we'd like to see these percentages above their high in 2021. A little bit easier hurdle for the traditional chart, a little more difficult one for the logarithmic chart. Now let's turn to our cash comparison charts. Here again, we have two different charts. One is a rate of change calculation. The other is a relative strength calculation. And we really see similar patterns to the universe trend indicators on both of these. The more sensitive chart is the rate of change, and we could see last recording in July was at 132. Pullback in the market has brought the numbers down a bit, but not enough to cause a O column. We need to see a little bit more of a decline there. And a decline, even an O column, wouldn't be a concern. In fact, we would expect it during most corrections. In March, when we had the correction surrounding the mini banking crisis, it did pull back into an O column before strengthening in June and July. But this points out the hesitation, no recordings in August or September so far for either of these cash comparison charts. The bigger concern would be if a pullback would drop below the March low, because that would move this chart back into a negative status. But as of right now, this is a positive pattern. It's a positive pattern for the relative strength chart. So once again, we expect this correction, unless things change materially to the downside, we would expect this to be more of a technical seasonal correction and possibly set up a buying opportunity as we get into, again, the year-end, October, November, December. And the last of the three core indicators is our long-term momentum indicator, and we have the update for month-end August. And once again, status is positive, even though August was a down month for the markets, as you can see here, with recording a loss for the month. That's the fourth month during this campaign. From the low in October, we've had 4 months where there was a loss in the MSCI All Country World Index, but that's not a concern. The momentum continues to improve here. There's one of the key momentum calculations in this indicator, and you can see it's moving to the upside. So really, in summary, all core indicators, each are showing a little bit of weakness, which you would expect during a correction, but none of them are showing any significant deterioration or cause of concern that we've started a significant downturn in the market. Let's move over to the tactical indicators. And what we're going to see is that both of these indicators are in the neutral status. Both have come off of their highs, of course, that we hit at the end of July. And both continue to move to the downside a bit. So here's the percent of stocks above their 10-week average. You can see the number is around 42%. At the end of July, we were up at 72%, just came short of hitting the high risk level. And at the low so far, we dropped a little bit below 40% before a little bit of a rebound, and now starting to head south again. So with this indicator, at some point, we would expect to see it down near that low risk zone during this correction. And that could set up a good tactical buying opportunity potential. But as of right now, we think there's probably a little bit more to go. There's always a chance that was the low. The August low at 38% was the low, although we wouldn't put great odds on that. We expect to see a little bit more movement to the downside before a good, solid tactical buying opportunity is set up. And moving to the overbought, oversold indicator, really it shows something very similar. We hit the high in July. We were in the overbought position. When that happens, we know that the ability for the market to continue to move higher becomes a little bit more limited. We got a quick pullback to the bull trend average. And that's very typical. Once we get an overbought condition, coming to that average is typically the first hesitation point. Very similar on the way up when we were oversold and we hit that average a couple of times and market hesitated before ultimately moving to the overbought position. Now everything is developing in reverse, where we're coming off of overbought, hitting the neutral level. Wouldn't surprise us to see another leg down into or close to the oversold zone. And if that happens in tandem with the 10-week chart, it could set up a good technical short-term buying opportunity to participate in a rebound in the market towards the end of the year, maybe into the early months of 2024. So from a market model perspective, the core indicators continue to hold up very well. The tactical indicators are doing what we expect them to do during a correction. They're pulling back off of their high risk overbought levels. They both come into that neutral zone. Next step could possibly be a movement to low risk and oversold, and that could set up a buying opportunity as we come out of the seasonally slow August, September period and go into the seasonally stronger October, November, December period. Now, what could put a wrench into that forecast would be the recession window closing. If a recession is developing sooner rather than later, it could limit a year-end rally in the market. It could cause it to be somewhat more limited or even prevent it altogether. So let's take a look at how our recession models are developing as we now have them updated through the end of July. Starting off with the monthly leading index, we could see that these are deeply in recession territory. The long leading index has been coming up for a couple of months. The leading index also has been coming up, although a little bit of a setback in July. Oftentimes when these leading indicators are beginning to rise in recession territory, it's the commencement of a recession. You could see that happening time and time again. Whether that happens during this particular cycle or not remains to be seen. There are some nuances in this cycle that are causing recession and economic models to come off of their traditional cycles, the COVID rebound and everything surrounding that, the amount of stimulus in the financial system, both from the federal government and the Fed, which is now moving in reverse for the Fed, but the federal government continues to pump money in through fiscal spending. The amount of excess savings in consumers through these various stimulative measures are beginning to run out from a lot of reports that I've seen. And we'll see how this all plays out. But right now, we continue to be very negative with these indicators, although improving a bit. If we look at the weekly indicator, we pointed out how it did move out of recession territory at the end of June. It stayed out of recession territory at the end of July, although no further improvement really, just kind of a lateral movement. It's modestly positive at this point. Once again, when you see these upturns is typically when we're into or beginning to start a recession. So with the weekly slightly positive, the monthly still deeply negative, we continue to view these indicators collectively as there's likely to be a recession in the future. What I'd like to do now is look at a few of the individual economic statistics that are in these indicators, and we could get a little bit more insight as to how the economic cycle is developing. One of the big ones is the housing sector and U.S. housing starts. And what we saw was coming off of the high in 2022 was a big drop in the middle part of last year. And that's one of the things that has caused the recession warning models to turn negative last year. And what's happened since then has been a little bit of a lateral movement, not a meaningful improvement, but no further deterioration. Still seeing a lot of housing starts, but it's holding that big decline that we saw in the middle part of last year. So we'll see how housing starts move from here. If there's some continued improvement as we go into the end of the year, that could help the economy continue to stretch out without a recession. But if things begin to deteriorate further in housing starts, that could come simultaneously with a beginning of a recession. Let's look at money supply. Obviously a significant influence on economic activity, and we're seeing kind of the tail end of the boom in the increase in the money supply there. And the peak in 2022 started to deteriorate and continues to drop. We've now seen about $2 trillion come out of the M1 money supply over the last year or so. And that's a leading indicator for the economy. Less money in this financial system, generally speaking, will equate to less economic activity. And in fact, it's very rare for money supply to be dropping like this. Typically, even a leveling off of money supply is enough to cause a recession, but we've seen a pretty significant drop off in these numbers. All right, next thing we want to look at is the yield curve. The yield curve, very simply, is the difference between short-term interest rates and longer-term interest rates. Typically, longer-term interest rates are going to be higher than short-term interest rates. When the opposite is the case, it's cause for concern about the economy. So what we see now is the gold line, which is short-term interest rates, specifically the federal funds rate. That's what the Federal Reserve controls. When they move interest rates, they're moving the federal funds rate. So you can see as the Fed has increased interest rates, we're doing it very rapidly last year. Lately, more baby steps with the increases in interest rates. But really what's important is we're now above the purple line, which are longer term interest rates, and specifically the 10-year Treasury bond rate. That first went inverted, meaning short-term rates are above long-term rates as of November of last year. So we're about 10 months or so into it, and we remain inverted, where the Fed funds rate is 25% above where the 10-year Treasury rate is. Now let's look at the full history of this chart to show why that's so important. And it's because pretty much every time there's been an inversion in the yield curve, gold above purple, there's been a recession. Right? So here's the 2008 recession, here's the 2000 recession, the 1990 recession, and all the ones here in the 70s, 80s, 60s. You could see gold above purple repeatedly, but by varying lead times. If we go back to the last significant recession, of course, we could see COVID, which also did have an inversion, very short inversion, but that was a different type of government-induced recession. When we look at recessions caused by natural economic cycles, there are varying lead times. For example, when we go back to the 2008 recession, the inversion first happened in August of '06. What followed that was a peak in the market in October of '07. So about 14 months after the inversion, there was a peak in the stock market. And then the recession started in January of '08. The one in 2000 was a little bit faster, wasn't as much of a lead time. So they all have different levels of lead time and different amounts of inversion. But you can see this inversion is significant, and more than likely is eventually going to cause a recession. The question is more when rather than if. So these are the things we want to continue to watch to determine if that recession window is closing, if that could prevent a year-end rally from developing and cause this market pullback to turn into something and develop into something more material on the downside. And the last thing we're going to look at on the economic side is the U.S. unemployment rate. Right? And what we saw was obviously a big drop in unemployment from the COVID highs. and we came down to a low of 3.4% unemployment rate. What we see now is a little bit of a pickup to 3.8%, still very low, but the numbers moving up a bit. I've seen reports and studies that showed whenever you get a 0.5% increase in unemployment from the low, we've always moved into recession. We're now at 0.4% increase from the low, but you can see the numbers have been moving up. If this continues to move up in the months ahead, that could shorten that recession window and cause a potential downturn in the market. Recessions typically always cause corporate earnings to drop. That always causes a downturn in the market. So that's one of the reasons why we're so focused on the recession potential and the economic statistics, because that could have meaningful effects on the equity markets. So when we look at the market itself and the technicals, other than the pullback and seasonal correction that we've seen develop here recently, we're not seeing a recession developing from a market perspective. When we look at our economic models, they've been negative for almost a year now. It was middle part of last year when they went negative. We now have the numbers updated through the middle part of this year. So that's a good amount of lead time. We could expect a recession to develop at any time, but when we look at the market, we're not seeing that happen. So it could just be that we have an economic cycle that is requiring a longer lead time for these traditional indicators to call a recession. So it's very possible the pullback we're seeing right now is a buying opportunity if it continues to develop. We're not there yet. But if we get a low risk level in some of our tactical indicators, it could be an opportunity to rearrange models and portfolios and reallocate into different industry groups and sectors and participate into an opportunity that might develop towards the end of this year, maybe stretch into the early part of 2024. We'll continue to watch our recession warning models to see if that recession window is closing, because that certainly could be one of the things that prevents a year-end rally from developing or maybe limit that opportunity. That's going to wrap up this update. Thanks for watching. Have a great weekend.